Tamia, how are you doing?
Good. Thank you so much for your time. We're so happy to have you here.
Yes, thank you for having me.
All right. So we'll go ahead and get started. So, guys, if you're listening to this on replay, drop a hashtag replay in the comments. If you're on Zoom with us and you're a member in the cohort, please drop your questions and comments. And if you're on Facebook group, drop your questions and comments, and we'll try to get your questions at the end. So all physicians you have heard about doctors sheltering multiple six figures of clinical income in taxes, but then they talk about cost segregation, bonus depreciation, and we kind of all feel lost. So today we will be decoding complex tax strategies with our industry expert, Kim Lochridge. She's a big league tax expert for Fortune 500 and ultra high net worth individuals. So we'll be diving into how cost segregation and bonus depreciation work, the time value of money and tax savings it can get you, and also tips on how to choose a cost segregation firm. So let's get started and learn how to maximize real estate tax savings. Welcome, Kim.
Thank you, Simone. Hello, hi everyone.
So, introducing our guest speaker, Kim is an executive vice president for Engineered Tax Services. That's an industry leading provider of specialty tax services in the United States. Kim has an amazing understanding of tax codes as they relate to real estate and energy efficiency incentives, making her a big league tax expert. Kim is personally a real estate investor since the late 90s, and she's on the tax committee for the Washington, D.C. based Real Estate Roundtable Group, where she collaborates with top lawmakers and holds a variety of other board positions. So we are very, very happy and thankful for her time.
Thank you for having me.
All right, so getting started here on some questions. So for our listeners, Kim, who are might not be familiar, can you explain what cost segregation and bonus depreciation mean?
Okay. In layman's terms, cost segregation is an alternative method to depreciating property. So, if you don't do a cost segregation, you have to depreciate on a straight line depreciation. Commercial property is 39 years. Residential property is 27 and a half. Short-term rentals fall under the classification of commercial at 39 years, just for a delineation. By doing a cost segregation study, we actually take that entire building and instead of depreciating it over 27 and a half or 39 years, we get to extract some of the assets that will not last that long, like carpeting, for instance, or specialty electrical appliances, landscaping, irrigation, driveways, right? Those types of things aren't going to last 27 and a half or 39 years. And so the IRS allows us to put those in different depreciable buckets if you do a costing study. They don't want just anyone doing it. So you've got to have a professional qualified engineer to be able to come out to the property to break down those assets. Not only are we breaking down the assets, but we're also breaking down the cost to those assets and including also a condition factor to each of those assets. And that is what drives the benefit for cost segregation. Okay. So the cost segregation is just an alternate method of depreciation, as I mentioned. So instead of depreciating it over this straight line depreciation, we're depreciating it under the MACRS methodology. That's the MACRS methodology under accounting. Bonus depreciation is different than cost segregation. I know there's a lot of myths out there, and someone will call and say, hey, I want to get my bonus depreciation. We need to do a cost seg study first in order to get the bonus depreciation on like a purchase, for instance, or a new construction. So bonus depreciation kicks in during certain years at certain amounts. And it's dictated by the IRS, and Congress had put forth those rules for us. And essentially the bonus depreciation, depending on the percentage of each year, will kick in on buckets or assets that are in a bucket that's less than 20 years. So when we shift the carpeting into a 5-year bucket, bonus depreciation applies. If we shift your landscaping into 15 years, bonus depreciation applies if it fits that criteria. So bonus depreciation and cost segregation are two completely different things. Bonus depreciation is a result of usually a cost segregation study.
That's correct. That's correct. So that's great information. So Kim, a lot of here our guests are interested in short-term rental properties, and they were wondering if this applies also to short-term rentals, and so how does that go with those kind of properties?
Yeah, short-term rentals are hot right now. Obviously, we have a lot of short-term rentals coming on the market because of the material participation, rules. And short-term rentals, I would say, as long as you have a basis of 200,000 or more, it would be beneficial. We can do them for the smaller properties, but it might be like a different type of study. But we can certainly do the short-term rentals. We here at Engineered Tax Services, we do cost studies on every type of property, anything from a single family home, multifamily, retail, residential, office, medical office, gas stations, car washes, self-storage, warehouses, distribution, name it. We do it all. So if you own investment, property or income producing property, a cost segregation is usually a very good option.
That's awesome. Yeah, that's good to know that you serve a variety of property types. So a lot of our physicians have their own practices and they own a multiple business, and then now they're getting into real estate. So it could be an avenue for multiple ways to do this.
Yeah.
So
And
excellent.
we talked about the short-term rentals being a great option because it does help offset the W-2. But if any of your doctors actually own their own medical office space and then rent that back to themselves as a self-rental, they can actually also usually qualify for offsetting their W-2 wages. That could be active income for them because they're housed in that office building. So don't forget the medical office spaces, or let's say you lease a space, but then you put in maybe $200,000 or $300,000 or $500,000 worth of improvements or tenant improvements in that. We can do a cost seg study on those improvements as well. So there's so many ways to utilize a cost segregation study.
That's great to know. It's great to know. So Kim, walk us through what a typical cost segregation study process looks like. Starting from calling you and getting you on board, and then what does it look like in the process?
Yeah, so the process takes about 6 weeks from start to finish. But once I get the information, usually just a settlement statement or an appraisal, I can usually do a benefit analysis and a fee structure for each individual. Usually those turn around in 24 to 48 hours, so we can get those out pretty quick. That way you can have an idea of what you think the benefits or what we think the benefits are going to be, as well as the cost to do the study. Once we get the signed contract, we do require 50% down, and then we get going on it. About 6 weeks later, we will deliver the final report. In that time period, we will be doing a site visit by our engineers. That site visit usually happens in the first week or 10 days after they sign the contract. And once that site visit is done, then it just takes our engineers to rebuild that building.
Perfect, perfect. And so, Kim, what is a good timing to get a cost segregation study? Most of our clients are getting into properties, they're looking at deals and maybe closing here soon. Some of them have closed. So should we get on this right away, or should we wait till, tax time? How do you think that would be a best time to do this?
Yeah, it's a great question. I, if I had a magic wand, I would suggest that everyone does it as soon after close as possible. The reason for that is because once you close on a property, there could be renovations or modifications that you do to that property in order to get it up to speed or running or making some repairs or improvements, or maybe just extensions, expansions, things like that. When we do our cost seg study, we are establishing a baseline to prove to the IRS what was there at the time of purchase. So if we can get in that property before you make any adjustments, improvements, renovations, or any construction differences, that's always best. Now we can always go back and recreate and try and, put together what was there before that if you've already done improvements. So it doesn't prevent us from doing it. But if I had a magic wand, it would be easier for all of us if we can get into that property as soon after purchase as possible. Again, so that we're setting that baseline for the IRS and proving what was there. Any major improvements over $50,000, we can also do kind of an add-on study, and that one will essentially break out all of the different buckets for the improvements as well. And as mentioned, that's like a threshold of about 50,000.
So you're basically segregating what was already there at the property. So let's say I go in and do improvements. Let's say I put in make a new fence, I put in a hot tub, things like that. So those will be excluded from the cost segregation study?
From the original purchase study, yes. And then they would be layered on top. So essentially we set the baseline by doing the study on the existing building, what was there at the time of purchase, and then all of those other things get layered on top.
Got it. Okay, perfect. And also for, a lot of, people get into short-term rentals in their first year. And then in the second year, they are turning it into passive, passive income. So talk about, maybe using syndications as passive income, passive losses to then offset the passive income in year 2 or year 3 when these are the rentals are earning passive income at that point. Have you had clients who are using that strategy?
Yeah, I do. So getting the short-term rental up and running is, a huge benefit. If you're following the material participation rules, you're taking, you're calculating your hours and you're tracking all of that, and you're actively managing that property, then with the material participation rules, the deductions from the cost seg study offset your W-2 or ordinary income for the household. That's always a great time to do it. Like right now we have 60% bonus depreciation, so you get 60% of that upfront. All right, so obviously it was better when we had 100, but hey, 60 isn't bad. So we take the 60%, not of the total purchase price, it's 60% of the assets that we put into the 5 and 15-year property. Okay, so I don't want to mislead anybody. But that typically works very well. And then if you say, for instance, either don't meet that material participation in year 2, or if you decide to change that into convert it into a long-term rental the following year, then essentially it just converts. You have to qualify for the material participation every year. If you don't qualify for that material participation in 1 year, then essentially it just offsets your passive income. So that means the income from that long-term rental will be passive, and then the deductions will offset that income, but it will not offset the W-2. For a visual, explanation, I find it, if you have ordinary income, like from your W-2, you can offset things like, you can offset that with things like your if property tax or your mortgage interest, right? You can do those things. And if you end up, if that's ordinary activity, right? Now, if you have investment property, that would be a long-term rental, it would be on the passive side. It's a separate bucket, right? So you have 2 buckets. You have your ordinary bucket and your passive bucket. And if you think there's an imaginary line between the 2, you cannot cross that line. Okay, so there's these 2 different buckets. What's passive activity stays here and can just offset what happens here. This side is your ordinary and only offset what happens here. When you have material participation or a short-term rental, that line disappears and everything gets melded together. That's why the depreciation offsets W-2 income. But on a long-term rental, it remains passive, and you put that line back delineating the 2 buckets. So once you have to go back to non-material participation, or you turn it into a long-term rental, you've got the majority of the benefits up front anyways on that one. So turn it into a long-term rental, save yourself a little bit of time, get a long-term lease in there or whatnot, and then start a new Airbnb. And then you can take the material participation from the new one, and then the next year turn that into a long-term rental. So it's actually a really great process to be able to do something like that, and still be able to offset the majority of, or use that depreciation to offset your income.
Right, right. That's awesome. And that also is true for syndications, right? Like uh, I know Param's group has the gwcapital.com where they have investment opportunities for syndication. So you could take the bonus depreciation from the syndication as passive losses and then offset the passive income that now your short-term rental is making in year 2, which is the passive
Correct.
income.
Which would be in a long-term rental. Yes.
Yes, yes,
Mhm.
yes.
That's right.
So that's
Yeah,
those are great.
that's a little bit more complicated. When you have multiple activities in your passive bucket, say you have the syndication and then you have a couple long-term rentals, your income, your losses can offset the income on the passive side, but you need to group them together. So your CPA would have to group those activities together in order for them to offset. Otherwise, they stay independent for each passive deal. Okay, so there would be a grouping election that needs to happen.
That's good to know. That's good to know. That's excellent. And so, are there any, upcoming changes? We mentioned, 60% bonus depreciation this year, and we are hearing rumors about, 100% bonus depreciation coming back. Do you have any inside, information there on what's going to happen in the next few years?
Yes, and thanks for asking, because there's a lot of misconception about that. Everyone thinks the 100% did come back because it passed the House. It did not pass the Senate. So we got through halfway. I will give you some kind of inside information as to why this is so tricky, so that you're all educated about it, because I think this is very important. Um, there So we have, two sides of our government, right? So in the bill that the bonus depreciation is housed in is also housed with the child tax credit, as well as amortization for the research and development tax credits. So they're bundled together, among other things, but those are the biggest ones that impact me personally. So those are the biggest ones. The bonus depreciation is kind of a no-brainer. It's just a reallocation of depreciation. It's not any more or less money in the pocket of the IRS. It's essentially just spread out over a different time. Same thing with the amortization of the R&D. The problem is the child tax credit is very controversial. So because they packaged it with the child tax credit, that's what's holding the whole thing up. That's why it passed the House, but it did not pass the Senate. The senators, what's happening in the child tax credit, and I think this is important to shed light as to what's really going on out there. In this American Family and Workers Act that the bill was proposed, the child tax credit is one, they're saying that they want to give the child tax credit based on 2 year ago salary, which was essentially COVID. And so what they're trying to do is use salary from 2 years ago to give you a credit today, which Republicans are saying we think that's inflated. So the other thing that they're trying to do is they're trying to give the child tax credit to anyone who has a TIN, a taxpayer identification number. You do not have to be a citizen of the US to have a TIN number. So what they did was they opened up all the borders. They're bringing in a lot of illegal aliens, allowing them to cross the border. They're giving them TIN numbers, and now they're trying to get them the child tax credit to people who aren't even citizens of the United States. That in itself could be a controversial topic. The Republicans are trying to stop that. But I think the biggest issue politically is that it's a very slippery slope, because once you allow someone with a TIN number to get a tax credit or cash in their pocket, because it's a refundable tax credit, then they could propose that, hey, now we're going to let people with a TIN vote. So now you have the problem with, yes, we've opened up all the borders. We have a bunch of illegal aliens here. We're giving them money through a taxpayer identification number, and now we're going to allow them to vote even though they're not citizens legally. So as you can imagine, the Republicans are up in arms about the child tax credit. It's a huge issue and very controversial. And this is what's stopping our bill, right, for the bonus depreciation. So the child tax credit is much bigger than the bonus depreciation. So in this sense, what we're hearing on, from the senators is that they're just going to pause on this particular bill. They'll either repackage this away from the child tax credit, or they're simply going to wait until after the election to decide who takes control of the House, and then decide to put together another tax bill that's more robust. That's just, has to do with those things and uncoupling it from the child tax credit. So that's really what's going on behind the scenes. That's why we have this, did it pass, did it not pass? That's the God honest truth, so everyone can take it. You've heard it here. And hopefully that helps fill in some blanks as to why this has stalled.
Wow, that's great information. So for now, we'll just stick to the 60% for 2024, and then
for now.
40% next year, if nothing changes, right?
Yeah, but let me just make sure that everyone understands this part of it too. Let's say you get 60% bonus depreciation. The bonus depreciation applies to the 5 and 15-year property, remember? That means you get 60% of it up front. The other 40% is still delineated over the 5 and 15-year buckets. You're not losing it.
Right.
You're going to get it, and you're going to get it faster than your 39 years or 27 and a half years. You just don't get it all in year one. But what's really interesting to remember is that most people, I mean, if you're doing a short-term rental and you have a high income, then yes, you can use the deductions. But if you're in a passive situation, you can't use all the deductions. It just rolls over to the subsequent year. So you can use it multiple years. So it's not as bad as it sounds. It's not like you're missing the other 40%. You're going to get it, and you're going to get it in shorter buckets. You just don't get it in year one. So it's kind of nice for some people who are high income, because it actually feathers the depreciation across 5 years. And so that you're taking little chunks off of every year's salary instead of just one big year, and then you have to deal with the tax burden the following year. So it could actually be a really nice tax strategy tool by just taking the 60% and then shifting it over for the rest of the 40. So I just wanted to leave that because I think it's an important topic.
Yeah, that's a great perspective. So like you said, you still will get the 100%. It's just, when you get it. Yeah.
Exactly.
That's great. So yeah, I mean, so that brings me the topic of, what happens when you sell the property. So that's very confusing for everyone. What is depreciation recapture? And then do we have to give all of that when you're at that point of selling?
Yeah, another great question. I really appreciate it. So when you do a cost seg study, imagine a portion of the building again goes into 5-year bucket, 15-year bucket, and the remainder goes into either 27 and a half or 39-year bucket. Okay, so you have all these buckets to deal with. So let's say you did a cost seg study and you have a 5-year bucket and you sell it in year 3. Okay, so recapture is kind of like prorated, right? So you've already taken the 3 years, you pay back the 2, right? So, but what ultimately happens in recapture is that you pay back what depreciation you have not taken, that you took up front, but you didn't have it all. So it's kind of like getting an advance on a paycheck. Let's say you start a job and you go to your boss and you say, pay me 5 years up front. Okay, here's a check. And then you quit your job in year 3 when he paid you 5 years. You don't get to keep it, right? You have to give back the 2 years, but you worked the 3, right? So there's that. But also there is a way to get around the recapture, and that's if you do a 1031 exchange, then essentially you don't have to pay that back. You basically just roll that over into the new project. So you still get to keep the benefits. So I always recommend that, if you buy a property, do a cost seg study, and then you have an offer you can't refuse. You weren't really planning to sell it, but you have this great offer in year 2 or year 3. Certainly do it. Run the numbers both ways, because there's multiple ways that you can get out from underneath paying that recapture, but a 1031 is the easiest. But run it both ways, because there might be some other options that you could do there, especially if you're going to be buying another property. So just so you know, the recapture, yes, is there if that's all you're doing. But you want to incorporate some of the other tools and incentives out there so that you don't have to pay that.
Right. So yes, so 1031 is basically rolling over into a bigger property and to another investment property,
Mhm.
so that you can avoid the recapture at that point. So you guys, I mean, we can introduce you guys to 1031 exchange providers as well, if anybody's looking for that. So perfect. And so a lot of people have asked, do I have to do the in-person engineered cost segregation, which we all recommend, but then we see people, doing some cost savings with DIY studies. And could you tell us, why that's not what we need to do?
Yeah, the IRS has a guide. It's called the Audit Technique Guideline for cost segregation. So the IRS wrote a guideline for the IRS auditors to follow when and if they come across somebody who has a cost segregation study in that return. So basically, in that audit technique guideline, we get our regulations, we get what they're looking for, we know what their intent is, what they want, and it is very, very clear that they do require an in-person site visit. They mentioned that probably 15 times in the audit technique guideline. In addition, at our last cost segregation conference we had speakers from the Department of Treasury come talk to us, auditors essentially, and telling us that if we do see a cost seg study and it was not visited, or if it was a virtual study, we will just throw it out. It will not be accepted. So it's very clear in the audit technique guidelines that what their intent is and what they're specifically looking for. The virtual site visits were approved and allowed short term for COVID because we couldn't travel. We weren't supposed to be in close proximity, so it's normal that we could still do those, but we would have to do it virtually. That has since been turned off. The IRS has been very clear about that was only during COVID, and the only way that you can get out of not doing a site visit is if you had COVID. So now we're kind of outside of that. The other thing is that I see some of uh, our competitors are doing, they hire somebody like a photographer to go take some pictures. I mean, anyone can take pictures, right? The IRS wants to see that it's a qualified building professional, and somebody who is a photographer is not that. One reason for that is when we do our studies, we are doing a condition factor. We look at the age that's left of each asset. So when you go in with somebody who's not a building professional, are they really going to know how old that HVAC system is? Are they really going to know how old or how many years are left on that roof? That's not something you can just take pictures of and bring that back. So you need to have somebody who is really knowledgeable about what they're doing, and do it right. Yes, it might save you $1,000 to go with a DIY or something like that, but what is the risk if you get audited? I will tell you also, not to scare you, but everyone knows that the government had approved for the IRS to hire 87,000 new agents. They're putting those towards audits. So we've seen a huge uptick in audits lately, and that's something that is just the nature of the beast. So they are looking for these. Now they have the manpower to do so, and I think it's important that you get what you pay for. Make sure that you're doing it right. You have a qualified professional. Our company's been doing this for 23 years. We have a fantastic track record, and we have a great relationship with the Department of Treasury. That's who want to be looking for that longevity and make sure that you're getting a legitimate study.
Right. So that's great information. So yeah, I mean, we're ending the talk here. Any final advice you would give to our physicians who are getting into real estate? Any top tips from the expert?
I would just make sure that when you're doing deals, when you're doing your due diligence, make sure that you're using a worst case scenario, especially in short-term rentals. Short-term rentals are growing leaps and bounds. And if you know anything about economics, it's a simple supply and demand. We have a lot of short-term rentals coming on the market. Okay. Let me give you some statistics. Our company runs between 400 and 600 studies a month across the country, in every state across the country. 47% of those are single family homes. Okay. This is a huge change for us over, say, 3-4 years ago. I would say the majority of those are short-term rentals. When you have that many short-term rentals coming on the market, there's bound to be some supply issues, right? Supply and demand excess. So that's going to drive the costs down to what you can rent those properties for. And I think anyone who's done short-term rentals, I've done them since 2011. And anyone who's been in that space knows that there's definitely the last couple of years been an impact on the income for short-term rentals. So run your numbers on the worst case scenario. Do not rely solely on the income from that property with assumptions. It's going to be really hard to know exactly what that income or what that property is going to draw. So just make it a worst case scenario. Okay. And then everything up there will be gravy. So that's my biggest piece of advice. Run the numbers, be realistic with those numbers. What you don't want to have happen is you get into a situation where it's not going to cash flow and you can't afford it. So that would be my biggest caution.
Yeah, that's what I say, because this is hard-earned money that we have worked very, very hard for, that you're putting into an investment. So it better be cash flowing. Otherwise, there's really no point chasing the tax advantage if it's really not cash flowing,
That's
So
right. That's right.
important to put.
And I think we did have a question about the remaining bonus depreciation. Do we have time to answer that?
Yeah, absolutely.
Okay, great. So we had a question. It was about clarifying the spreading the remaining bonus depreciation, the 40% over the 5 years. Could that be used against W-2 or passive income or both over those years? The answer to that is it depends on how you're structured. If you carry that material participation on a short-term rental through the entire 5 years, it will offset, as long as you have that qualification, it will offset your W-2 income. If in that year 2 scenario where we said you converted it to a long-term rental, then the next few years are going to be just offsetting the passive income. So that's kind of how it plays out. And it really comes down to if you qualify for that material participation every year, or whether you're active real estate professional or if it's passive. So it depends on the bucket that it's coming from. You're welcome. Thanks for asking.
So the next question is from Noha, and it looks like there's a question about land value and building value and how that factors into cost segregation studies. And is there a certain, sweet spot there when people are looking for properties?
Yeah, land value is tricky, and I'm actually glad it's coming up because it is one that, even we battle with all the time. So I'll just kind of go over what the IRS tells us. The IRS tells us for land value that we need to use a reasonable value for land.
Yes.
That's not very directive, right? So it leaves it open for what's reasonable. In the audit technique guidelines, going back to what the intent is for the IRS, they say first look for the appraisal, right? Look and see if there's a land value or a site value in the appraisal. And then you have to take a percentage of that, okay? Because your appraised value is usually not exactly matching up to the purchase price. So usually there's a little bit of a difference there. So you take the site value divided by the appraised value, you get a percentage. You apply that percentage to your actual purchase price. That's how you get land. Okay, that's the first option. The second option would be to look at the tax card, because usually what I find on single family homes, they don't usually give you a land value. It's usually not in the appraisal. So then we default to the tax value. The tax value is all over the board because every county sets their own value of how they're calculating land. California is the worst, probably. You can have one property where the land value is 80% and a next door of that property, the land value is 8%. And that comes down to how much that property has changed hands. And so it's not a really good methodology for actually coming up with an accurate land value. So California is also very proud of their land values. And so they're usually much higher than across the board. So look at the tax card and see if you can get same ratio there. You take the land value divided by the tax of value, get a percentage, and then you apply that to your purchase price for the year you purchase it. So that would be the second way of looking. The third way, if you can't really find a good source, would be, you could just use an average. 20% land value is average across the board in every state. 30% usually for California or New York. And then if that fails, the other thing that I tell people that you could do is just go get a market analysis for comps, recently sold lots, dirt, undeveloped, no infrastructure, dirt only. Get some comparables. You take the amount of the square footage of the property, compare it against your lot, and obviously take that same ratio. What is it price per square foot? And then you can apply that to yours. So those are the 4 different ways that you can come up with land value. It's not cut and dry. I wish it was super easy. And usually I defer back to the CPA because the CPA is the one who's going to be signing the tax return.
Right, exactly. You mentioned California. I know there are different, laws about bonus depreciation in California. Would you know more about that?
Yeah, so I think what we're talking about there is the federal tax rate is obviously the biggest, right? So you get the bonus depreciation applies. If you get a 60% bonus, then you can apply that against your federal taxes. But some states, I would say maybe half the states, do not recognize bonus depreciation. So you won't get the same exact value. Essentially, that's only going to depreciate over that 5 years on the state return. So you have to back out the bonus depreciation when you file the state return. So you don't get the same numbers. So you can plan to, if you can use the bonus depreciation, you usually plan that your tax rate, it's still going to be lower than if you did straight line depreciation because you have those 5 and 15-year buckets, but you don't get all that bonus depreciation up front, whatever that number is, 60%, 40%, whatever. You don't get it up front. You basically have to do it over their 5 and 15-year buckets respectively. So you do have to back out the bonus depreciation for certain states. Arizona, Washington, Oregon, California, New York, New Jersey, I know for sure they do not recognize bonus depreciation, and there are other states who do. So you can just type in a Google search, does Oregon conform to bonus depreciation rules? Okay, and if you type that in, it will tell you yes or no, whether they conform or not.
Right. That will apply to the state taxes, right? Not to the federal taxes.
Just the state taxes, yeah.
Correct. Which are very high.
Yeah.
Yes.
Looks like we have another question too. In terms of just bonus depreciation in comparable homes, would it be more for a newer home versus an older home, and a single family home versus townhomes or condos? That is a fantastic question. Single family homes have the structure and they usually have landscaping. And it doesn't really matter whether it's a newer home or an older home, because everything's going to be different. All those assets are going to have been replaced at different times, and usually the IRS has a kind of a category. It says if it's this, then you can put this much price on it. So there's 10,000 different assets in there that we have to control too. And so the difference though between say a single family home and a condo, typically you don't own the land, you don't own the improvements to the land, like the lawn, the irrigation, the landscaping. So essentially all of the value drives to the interiors of that asset, which actually move more the needle on the 5-year property, which is what qualifies for bonus. So condos and townhomes where they're kind of in an HOA, you really are only just buying the rights to the inside of that asset. And usually the condos and the townhomes, insurance-wise, are covered by the HOA, and the exterior. And so therefore it's driven towards much higher results in cost seg when you have a condo or a townhome. So on average, we're going to shift about 30 to 35% on a long-term or short-term single-family home. On a condo, we're going to see somewhere usually between 38 and 45%, sometimes 50 if we're really lucky. So it does perform higher if you have a condo.
Right. That's important to know that condos, some of them you don't own the land. And therefore they're sometimes cheaper to buy for the purchase price. And I used to wonder when I started, I'm like, why is the condo so cheap and not the,
Yeah.
the
Well,
home?
not
So
only that, but think about the going back to our land value conversation. Technically, you don't own the land. You don't own the rights to the land. You can't develop on the land. You can't do whatever you want to the land. You can't
that's
build on that land. So a lot
right.
of CPAs don't pull out any land for that purchase. So now you're starting your depreciation point from the highest number. You don't have to back out the land first and then have a reduced basis, right? So, condos all the way around are a better fit straight up for cost seg. You get a higher basis because it's less of a land value, if any, and then you also have higher returns. So condos are actually perform very well.
Right, right. We have a question about somebody who owns their primary home and then maybe in year 3 of owning that primary home now moves to another place and then converts that house into a rental. Would it be beneficial to do this a few years later after purchasing the home, or do you absolutely have to do it in year 1?
Yeah, this is another great question because I have some tips for you.
Yes.
We do see a lot of people who are using that model where they buy the primary residence, live in it for 2 years, turn it into a rental, and then they sell it after year 5 to still get their $500,000 capital gain. So when you have a homestead that turns into a rental, um, in order to calculate the basis, it's the lower of two things. It's either the fair market value, whatever it was appraised for at the time you turned it into a rental, or, and again, this is the lower of these two, and typically it's the second portion, not the first. So it's either the appraised or fair market value at the time you turned it into a rental, or it's the original purchase price plus any improvements you put into that property. Now, 10, 15, 20 years ago, I guess it was more like 30 years ago, we had to pay capital gains on the gain from a primary residence. Okay. So what people would do is they would save all their receipts for any improvements they put in the house because then they could deduct that. Right. And so then they wouldn't have to pay. Well, now that we don't have to pay capital gains up to $500,000 on a primary residence, nobody really keeps the receipts anymore. But if you ever plan to turn that into a rental at any time, even if there's a potential possibility that you could do that, my suggestion is you always keep all the receipts. Keep everything you've ever done on that home, because you can add that to your basis. If you don't have proof that it happened and how much, you can't add that to the basis and begin that as your depreciation. And usually it's that the purchase plus improvements, that's the lesser of the two. And so therefore, yes, you can do, as soon as you turn it into a rental, you're going to be starting the depreciation on it. That's when we can do a cost seg study. In order to get the basis of that, we have to get usually the purchase price plus any improvements you put into that property. So keep all of that, because it really does add up over the years. If you've lived in it for 5 or 10 years and you've done all kinds of improvements to that property, you're going to want to add that to the basis. And it's different than turning it into a rental and then doing the improvements. It's a different process. When you have a homestead and then turn it into a rental, you want to make sure and add those together, and it has to be the lower of the two.
Yeah, that's great. Let's see if we have any more questions here in the chat. Yeah, questions about the grouping election again. Any negative, anything that can go wrong there on the grouping election for passive losses, it seems.
What's the specific question about the grouping?
I think we talked about grouping, syndication and then losses from syndication and then passive losses from cost seg into one bucket.
Yeah.
And is that recommended? Should we do that or should we keep them separate?
I always group mine.
Yeah, okay.
Yeah, I group mine because I have a lot more flexibility doing it that way, and you don't have to keep as close track of it.
Mhm,
I mean, personally, I group them. I haven't ever not grouped them.
mhm.
So kind of up to you where it works the best. Um, then I think it's also important to keep in mind that if you have a lot of people don't know this, okay? So if you have a property that's passive, long-term rental or whatever, and you have losses from that property, from the cost seg study or whatever else, improvements that you've done or whatever, if you sell that passive property and you have those losses immediately convert to active and they offset your W-2.
Mm.
So I love that rule. And there are so many CPAs that miss that. They miss it because it is a simple checkbox that says that this asset is disposed of when it's sold. And it will automatically trigger the tax return to use that loss on the active side. But I see a lot of CPAs miss it. So if you do go sell a passive property, keep in mind that you're going to be able to use those losses, those bank losses, and offset your W-2 income, your ordinary. Okay, so that's another reason to do a cost seg on a passive investment, even if you can't use the benefit right now, because you could use that as a very, very good tax strategy. Let's say you have losses you want to convert, and then you wanted to cash out some IRA for whatever reason, and you're going to take the tax hit, you can use those to offset that cash out. So there's so many really strategic ways that you can use that tool.
Right. So,
Priyanka, I have the question, if you turn a primary residence into a rental and then you sell within the 5 years after turning it into a rental, do you don't need to pay tax on the capital gain? Yes, there's a rule. So you actually have to have lived in the house 2 of the last 5 years. So basically, you can live in the house for 2 years, turn it into a rental for 3 years, and then on that third year, sell it, and you still don't have to pay tax on the capital gain. So that's why a lot of people are using that strategy to live in a house for 2 years and then move out, turn it into a rental. So you have an exemption up to $500,000.
Kim,
So that's really nice
I,
to just pocket that money, right?
ca-
Um,
can I can I clarify that question?
oh yeah.
So if we have a primary residence now and we turn it into rental now, we've lived here for say last 5 years, and we sell it at 5 years from now. Do the 2 years now count towards it, or does it have to be? So if we have to sell it in the third year from now to count these 2 years to count.
Yeah, the 2 years, if you're gonna sell it now, no, if you're gonna turn it into a rental now, the previous 2 years are gonna count that you lived in it. So you have to live in it for 2 of the last 5 years. So that means that you, essentially, in shorter terms, you just have to sell it within 3 years after you move out.
Years, right? Okay, because I'm getting conflicting information about it. Somebody told me that you have to move back into this for 2 years
No,
for those 2 years to count.
no.
No, okay,
You just have to have lived in it for 2 of the last 5 years.
okay,
So if
sounds
you lived in it the last 2 years, that's 2 years, and it's going to be 5 years from the first date of the 2 years, but that's too complicated. It's just you have 3 more years to
right.
sell it, and then you still get to not have to pay capital gains. So the rule is you have to have lived in it 2 of the last 5 years.
Sounds good. Thank you.
Yeah, you're welcome. And then,
Sorry,
oh, go ahead,
I
Lorena.
just had a follow-up question. You mentioned that the max was 500,000. Do you mean when it comes to purchase price of the house? So basically, if the house is worth 1 million, we'll still have to pay capital gains or whatever is on top?
It's the gain. So if you bought the
Okay,
house for 500,000 and you sell it for $1 million, you have a $500,000 gain. You don't pay tax on that 500,000. You just pocket the money. If you bought it for 500,000, you sell it for 1.2, you pay tax on 200,000. You have a $500,000 exemption.
got it. Thank you.
Mhm. One other question, Lorena, you said we don't have to do costing the first year, correct? Does that mean we could continue the short-term rental in year 2, or we can transition to a midterm rental? Yeah, I mean, you can do a costing study anytime. It's just preferred to do it right when it becomes a rental. But you can continue doing a short-term rental, and it's going to revert back to what it was in that year, whether it was short-term rental or midterm rental. I think that is your question. If you want to clarify, feel free to unmute.
Yeah, so actually, sorry, maybe I didn't write it correctly, but what I was trying to ask was, so my understanding is that in order to, especially for short-term rental, if I am interested in the bonus depreciation, then technically it would have to be done the first year if I'm thinking about transitioning to a midterm rental or long-term rental later on down the road. So then my question is, say I have it, I use it as a short-term rental for the first year, but in year 2, I decide to transition to midterm rental. Can I still do the bonus depreciation despite the fact that it's no longer a short-term rental?
Yes, you're gonna get the bonus depreciation regardless of whether it's a short-term or long-term. It's just, can you utilize it? So
Okay.
let's say last year it was a short-term rental, this year it's a midterm rental, and you haven't done a cost seg. You can go back and do a cost seg study on it. What I would do is, probably, since you qualified, assuming you qualified for the material participation last year as a short-term rental, I would amend your tax return for last year. Normally, we don't have to amend it. Normally, we can just move forward and do what's called a 3115, which is a reconciliation between the old depreciation and the new. But you don't want to bring it into a year where it's a midterm rental because you want it to offset your W-2 income, right? I'm assuming.
Yes. Yes.
Yeah,
Mm-hmm.
so I would say go back and do a cost seg study on it for the year that it was a short-term rental. Make sure you have the hours logged, and then you file an amended return, take the deductions, get a refund check, and then you file the remaining depreciation with your current tax year and the midterm rental.
I see. Thank you.
Yeah, no problem.
Looks like one more question is that I believe if you have a loss on a sale, can't take it. There may be other things. So wanted to know current ability to group may override this. Unclear. Any, Ekta, are you around to unmute and ask the question? Probably on Facebook. So. Okay, anybody else who wants to go ahead and ask questions? We have just a few minutes left here. All right, I guess we are up with questions. So thank you so much again, Kim. Thanks for joining us. And this was so insightful. I learned so much from you today. And so thank you so much. Anybody who's interested in connecting with Kim, we dropped the link in the chat. It's www.generationalwealthmd.com/1031. So please send your request there and we can get you connected with Kim. Thank you everyone for joining, and we'll see you next time. Thank you. Bye-bye.
Everyone.
Thanks, Kim.
No problem. Anytime.